Preqin forecasts that global private capital assets under management will almost double to over $18 trillion by the end of 2027 from $9 trillion at the end of 2021. Which asset classes are you most excited about and why? And which one are you most worried about?
In terms of where we are most excited about the opportunity going forward, I really think that core real assets, and not just real estate, but thinking about things like infrastructure, transportation, those are going to become increasingly key parts of a diversified portfolio, given the uncorrelated sources of income that they provide.
Talked about private credit, particularly in Africa.
Firstly, this industry has already demonstrated phenomenal growth over the past 5 years, with AUM growing from 4 trillion to approximately 9 trillion, and that represents a compound average growth rate of 14%.
At the same time, we recognize that in a world of very low rates, investors are going to need to generate more robust rates of return. And so we think that there will continue to be a bid for things like private equity and private credit as well.
We're most excited about the business that we're focused on and have been focused on for a while within private capital, which is the direct lending business.
While inflation will come down this year, it will likely remain challenging and structurally higher than we've seen in the past. So for instance, the 2% target of inflation in the US would be like 3%. So it's really important for investors to optimize their portfolios to take advantage of instruments like inflation-sensitive assets, global linkers, TIPS, commodity-based real estate, and private real assets.
While many critics have been waiting for a slowdown in the global economy to be a trigger for market correction in private credit, it really continues to weather the storm. In contrast to the current global economic turbulence, the stability and flexibility that's offered by private credit funds, extending much needed capital to business at a time when traditional lenders like banks have been pulling away from doing so.
We remain positive about the M&A environment for 2023, despite ongoing geopolitical uncertainty, concerns about rising inflation and rising interest rates, and of course, a big consumer squeeze, which we're now experiencing. There do remain some tailwinds around M&A activity into private credit and private equity strategies.
With governments and a growing number of institutions around the world pledging net zero public commitments, there are going to be value creating opportunities as well as investment risks. The EU's goal of cutting carbon emissions in half by 2030 is a major investment opportunity. Private equity has an important role to play in transforming high emitting assets. Decarbonising industry will help us transition into a low carbon economy. A great deal of those emission savings are likely to come from the reshaping of existing businesses rather than necessarily the creation of brand new ones.
And separately, private equity is sitting on record levels of so-called dry powder, committed but uninvested capital. And we see that continuing to fuel M&A activity. And then of course, in a high inflation, low interest rate environment, we see that difference between real and nominal rates continuing to mean that long-end investors, insurance companies, pension funds, sovereign wealth funds are all going to drive credit into private equity and M&A, looking for long-term yield.
You've got a region which historically has been funded mostly by banks, and in an environment where interest rates have been rising and are likely to continue to rise. You've now got quite interesting cash coupon returns. When you put on equity kickers on deals, you're likely to start achieving, post 20% IRR, which is comparable with private equity.
And then with sector-focused funds, there is a high opportunity for impact. Take the healthcare sector, which is a higher opportunity for positive, measurable social impact. All sectors have an opportunity for social impact, but others have a high instance. We've already seen the mobilization of private capital accelerate climate-focused investment. We'll see more managers focusing their expertise in sectors like education, healthcare, food and agriculture, the water sector.
I'm really excited about, I don't want to say too broadly all the asset classes, but specifically in the private credit and private equity. I think real estate also provides good diversification.
I'm excited about private markets in their totality across all asset classes because it is ripe with opportunity to make investments that turn radical sustainability ideas that could profoundly shape our future into reality.
In terms of opportunities, an interesting stat that was quoted in the report is that if you look at private equity as a numerator and the denominator is the total market cap of private equity and public equity, private equity is still very, very small. And the forecast has it still less than 10% by 2027. So I think there's a lot of upside potential there.
Well, I continue to like private equity and venture capital, and Preqin forecasts that even with the expected moderation in performance, these two will continue to outperform other asset classes. Now, in the short-term outlook, we do expect performance to reverse as it tracks public market valuations, which are currently soft, and that also cools the deal-making and exit environment overall. But in the longer term, some investors can take advantage of the lower valuations, the lower competition for assets to seek out opportunities in the previous more overheated sectors like information technology. And we do see record high dry powder that could allow GPs to respond quite quickly as the opportunities arise.
Let's use climate change, for example. It is estimated that we need $5 trillion per year by 2030 to reach global climate mitigation goals. It's quite a sum of money and with tight turnaround on results. We have the capital, and private markets are where all great ideas start, and there are plenty of them across all industries, from energy to transport and agriculture, and within climate tech more broadly. Investment into these companies will accelerate progress far quicker than those into legacy companies, predominantly found in public markets attempting to transition.